Good morning, dear students. How are you all? Very good morning. So, we're meeting after a long time. I hope we have been doing good till now and your studies are also on track, right? So, we are like almost on the verge of completing the syllabus. Just few chapters are pending. That's what I understand. So, yeah, we have covered a really nice journey since the beginning, in which I was also having a significant part with you. And once again, we're together with the new topic, that's business valuation. Okay. So we have already covered the topic of security valuation, wherein we have taken up the equity valuation and also the fixed income instrument valuation. Along with that, some sort of convertible valuation was also undertaken in that particular topic. So now, when we are looking at this particular aspect of business valuation, so per se, we are not looking at value of one single security, but we are looking at valuing, a business as a whole, a business entity as a whole. The concepts almost remains the same, which we have learned in the security valuation. The methods that we have used, like the cash flow approach, the relative valuation, all of them are on the similar track. Okay. But yes, we are not looking to value one single share for the investment purpose, but we are looking to value the business as a whole. Okay. So some of the important concepts that we should be, I just try to recap as to what we have, what we are done in the security valuation and how we are going to apply it right now. So, this particular business valuation concepts are more or less similar to that of the security valuation, wherein we're going to look at the same present value concept, relative valuation, cash flow approach, right? So we already know how to take the present value. We already know what's the internal rate of return, return on investment. These are certain basic concepts that we should be aware of. Also, one typical aspect where I would like to stress upon is using the Gordon formula or the terminal value formula. Okay, so we've already seen in our security valuation chapter that the share prices are estimated based on the dividend that is expected. Okay, so it's estimated based on the dividend that is expected. So there is, like, we have already seen certain questions, like we might have year and the cash flows. It's like, let's say for initial 4 years, we're having cash flows of maybe next year we'll have a dividend of 10 rupees, and then it keeps on growing at 10%. So when it is going at 10%, obviously the second year cash flow would be like 10. On that you will have a growth of 10%, right? So this goes on till 4th year, and then we say that from 5th year onwards, the growth is going to be at a stable rate or at a lower rate. Right? The growth is going to be at a stable rate or at a growth or at a lower rate. That's like where we computed the terminal value. And I hope you can remember that terminal value can be simply computed as cash flow in the next year upon K minus G. Right? So I hope you can recall this concept that we have covered in the security valuation. That same thing is what we are going to use to get the terminal value. And then we are going to discount all these cash flows to the current level. Okay. Now, again, we can say some of the approaches that we are going to use similar to the security valuation. We have like asset-based valuation, earnings-based valuation, and also cash flow-based approach, right? So when we say asset-based approach, so you're using your balance sheet items for assets and liability to arrive at the value of a business. Now, in that one particular concept that we use is something called as net asset value, which is also called as a book value of the share, right? Book value of share. So book value of, or you can say book value of the business. That can be simply arrived at, fixed asset value plus current assets minus current liabilities, and then minus the long-term debt. Okay, so fixed asset plus current assets minus current liabilities minus the long-term debt. Right, so that's here we are just taking the values that we have in the balance sheet. So we just look at that particular balance sheet and then calculate it, right? The other way at asset-based approach is to calculate something called as net realizable, right? So net realizable value. Now in this net realizable value, we don't take the book values into consideration. We don't take the book values into consideration, but rather I'm going to take, we don't take the book value, but we'll take the realizable value of the assets and liabilities, right? So realizable value would be like at what price we can really realize by selling that particular asset. Right? So net realizable value is, we can say, a realizable value of assets minus realizable value of liabilities. Right, realizable value of assets minus realizable value of the liabilities. That's going to give us the net realizable value. There's another concept called as replaceable value, and this is popularly used in the valuation concepts. Now, this simply means realizable value. This simply means that how do we determine the cost of a group of assets and liabilities of a similar equivalent company in the open market, right? So, of course, it's better than the book value method because it takes into account what should be the real cost that you need to spend to build a similar company, right? And obviously, the value is going to be slightly, higher than the net asset value or net realizable value if it is really in a profitable position. But this replaceable value takes into account only the hard assets which are visible. There may be some other attributes that a particular company may have which may not be captured in the realizable value concept. That would be like some motivation of the employees, the systems that they have set, the work culture that they have set. Those things are not something which are measurable, and therefore this realizable value suffers from that disadvantage, right? So replaceable value is simply the cost of group of assets and liabilities of equivalent company in the open market. Okay, of a similar company. If I want to build up a similar company, what's the cost that I need to pay? Right. So that's your replaceable value. Now, these are the approaches which we have for asset-based approach. We do have the approaches which are income-based, right? So in the income-based approach, so in the income-based approach, what do we really calculate? The income-based approach is simply to, overcome the drawbacks of the asset-based approach, because these are, when we look at the asset-based approach, we may look into the valuation of assets, but we are really not interested in valuing the assets, but rather we are interested in valuing the business as a whole. So there are certain simple tools to calculate the income-based approach also. First would be using the PE ratio. We are quite aware, price to earning ratio. Price to earning ratio is simply the EPS, market price per share divided by the earnings per share. So that multiple we use to calculate the value of our firm. Like we have got the EPS of, let's say, 12 rupees. Suppose the EPS is 12 rupees and the P, price to earning for a similar entity, right? Price to earning for similar entity is, let's say, 14. So you can say that market price, or you can say price of the share should be simply 12 multiplied by 14, which is 168. Right? So price to earning ratio, price per share, it would be like EPS into PE ratio. Okay, fine. So that's your income-based approach, one of my methods, which is the PE ratio, which is very, quite simple enough we understand. Now again, another connected concept with this is, capitalization of earnings, right? So capitalization of earnings. Now, capitalization of earnings means simple. You calculate what is your annual future maintainable profit, right? Expected or annual, what is the amount of profit that you can maintain, and then you simply divide it by required return, or what we call it as also as a capitalization rate. So that's annual future maintainable profits divided by the capitalization rate, right? This is a second income-based approach that you can say. You can just look at the income of your company and then simply capitalize it in the form of value by taking the required rate of return, right? The most important and the most relevant formula method that we use for valuation is the cash flow based approach. In this cash flow based approach, we can simply calculate something called as free cash flows. Okay, we're going to calculate the free cash flows, and based on free cash flows, we are going to discount all the future cash flows to current level. Okay, so how do we obtain this free cash flow? Let's try to understand that first, and then we will look at how do we determine the value of an entity based on this free cash flow method. Okay, now how do we get the free cash flow that an entity has got? Free cash flow which the entity has got, it's pretty simple. We start with free cash flow based approach. Okay, so you have like profit after tax. From that, we're going to subtract like all your one-time incomes and add one-time expenses. So profit after tax is like taking PAT. From that, we are going to subtract one-time income, add one-time expenses. And also, since we're looking at cash flow, when we have computed PAT, we would have definitely subtracted the depreciation, right? So depreciation is something that's not you're paying in cash, right? Because you're paying depreciation by way of a book entry. So I need to add back the depreciation also, right? So we start with profit after tax. From that, we subtract the one-time income, add the one-time expense, and also add the depreciation, right? So when we do this, we arrive at free cash flow, right? So we are calculating, or we are obtaining the free cash flow. Right? So free cash flow. Once we have obtained this free cash flow, we are sure that this is not something, this free cash flow is not something that is going to be a constant term throughout. Obviously, there has to be some sort of growth in it. So free cash flow is going to grow by certain percentages. So you apply that free cash flow, the growth rate to the free cash flow over a period of years, right? So year 1, 2, 3 onwards, you can just take it up to like whatever is the number of years the question specifies. To that free cash flow, you are going to adjust two important aspects, right? So adjustment would be less working capital investment, because as the business grows, we know that there will be an incremental requirement of working capital, right? So working capital investment or increase in working capital, we can say. And also we are going to make capex investment, or you can say investment in fixed asset. So you do those calculations, right? So we just take up this aspect. And then finally, the number that we have is what we call as adjusted free cash flow, right? Adjusted free cash flows. So free cash flows less working capital investment less the capex investment is going to give you the adjusted free cash flows, guys. Okay. And once we have got these adjusted free cash flows, now obviously the next aspect would be to take the present value factor and then calculate the PV. So you take the PV of all of that, and not to forget, we'll also add to it terminal value of, or I can say we will need to add the present value of the terminal value of the fund, right? So you add the present values, to that you're going to add the present value of the terminal value. This entire total thing is going to give you the value of the business, right? So this similar concept we have done in the security valuation also, right? And how do we take this present value? Because this is a present value from the point of view of like if it's overall cost of capital. If this is from the point of view of entire company, it will be KO. If it's from the point of view of the equity, then you're going to take it as a cost of equity. And we know how to measure the cost of equity. We have already covered the concept of, the chapter of portfolio management, wherein we have done capital asset pricing model. We have also done the arbitrage pricing model, right? So those are the concepts, those are the numbers which we can really use to obtain the present value of the cash flow. So using the PV to calculate the PV factors. Okay. We have also seen something called as levered beta or unlevered beta. I'm not sure. I think we have or we haven't possibly. But rather, I would like to stress upon that point regarding the asset beta and the equity beta. Okay. So we'd like to see the relation between asset beta and equity beta. So risk of equity investors or equity shareholders. So risk of the equity shareholders is going to be measured by equity beta, right? But if I want to see what is the risk of business, then we have to look at the asset beta. The risk of equity shareholders is what we say as the equity beta, and risk of the business is going to be measured by asset beta. Now, let's try to understand it in the form of a balance sheet, right? Now, suppose we have a typical balance sheet, okay? In the balance sheet, of course, you have the assets. And instead of saying the assets and liabilities, I would like to say, sir, these are like, the money whichever you have invested. And you have the fund providers, one of which is equity and other is the debt, right? So one of which is equity and the other is the debt. Okay. So we're like looking at asset being the investment or the application of the funds. And on the other side, you have the sources of funds in the form of equity and debt. Now, out of these two, which is the source of risk, guys? Which is the source of risk? Are the assets which the business has invested, are they the source of risk, or the fund providers are the source of risk for the business? Which is the source of risk? Is it the asset, or is it the fund providers, or is it the investors, or is it the money that you have bought? Of course, it is the assets which is posing risk for the business, right? Business risk comes from the asset side, whereas the financing risk comes from the way you have funded your business, but we are talking of the business risk. So business risk is coming to you in the form of beta, and that is obviously the asset beta, right? So ideally, whatever is the quantum of beta, the risk that is coming from the business, that's what we call it as an asset beta, right? Or the fluctuation in the returns that we have from the asset. So when we are simply talking of the fluctuation that we have from the earnings from the asset is going to be measured by the beta. The volatility of return of assets is going to be measured by the asset beta. Of course, whatever risk has come from the assets, that has to be borne by the equity and debt, right? So let us say here, the amount of equity and debt. So amount, like, let me call it as E and let me call it as D, right? So equity and debt. Then we have like beta. So obviously the share risk that the equity shareholders are taking is going to be written as equity beta. Whereas if you look at the debt, what is the beta for the debt, guys? What would be the beta for the debt? Is there any beta attached with the debt value? Can you really change the returns that you're going to give to your debenture holders based on your business returns? No. So debenture holders are essentially not taking any business risk. So therefore, their beta is essentially zero. Right? So their beta is simply going to be zero, right? So when you look at the simple thing that, you take the weights, then you do the weights into beta. So this particular number should be equal to your asset beta, right? So weighted average of the beta which is earned by both the equity and debt should be equal to the business risk, right? So equation point of view, we can say that weight of equity into equity beta plus weight of debt into beta of debt will be equal to asset beta, right? Now, what would be weight of equity? Weight of equity will be obviously equity upon debt plus equity into equity beta is equal to asset beta. Now, of course, this entire portion will become zero because debenture holders don't have any beta, right? So we can simply say, sir, equity beta is asset beta into debt plus equity upon equity. And you can also say, if you have got taxation, then it will be asset beta into debt into 1 minus tax, right? Because when you have when you have taxation into the picture, the risk that the debenture holders, the cost of debt gets reduced, and equally the financing risk gets reduced by a bit, and therefore this is what we have as a final formula for this asset beta, or the relation between the equity beta and the asset beta, right? Or you also call it as geared beta and ungeared beta, right? So we already know all of these aspects, right? Now, when we are looking at this particular formula of equity beta and asset beta, we would like to know, sir, what is the reason or what is the application of this? Now, this is going to be widely used when we want to value unlisted company. When we want to value unlisted company, right? So, for example, just to give you a practical aspect, recently there have been talks of an IPO by one of the leading market maker into the food delivery business, right? Like, for example, you can talk of the food delivery business already, which is a food delivery business which is already listed, guys. The food delivery business which is already listed in the market. Yeah, which is a food delivery business which is already listed in the market, Zomato, right? So if you have similar company coming into the IPO or coming into the IPO valuation, how do we really go about calculate the value of that? Because ultimately value is going to be present value of future cash flows, wherein we are going to take the present value using the discounting at the rate of KE, cost of equity, right? Now to compute cost of equity, of course, we need risk-free plus beta into RM minus RF. That's the CAPM, which we are quite aware of. Now, how do we get the beta of an unlisted company? Beta of unlisted company. We don't know, right? So what we essentially do is, so for example, if I want to undertake or we want to calculate the beta of Swiggy, let's say. So we already have a company which is listed on the similar line of business in the market, which is Zomato. So you can compute the beta of Zomato by using the past returns of Zomato and Nifty. So you compare the Nifty and Zomato returns, and then you calculate the beta of the company. Okay. Now that beta of the company which you compute using the historical data of the of the company and the Nifty, you're actually getting the equity beta of Zomato. But can I use that equity beta for valuing Swiggy also? No, because equity beta of Zomato is dependent on its debt and equity numbers. So as the debt and equity numbers changes, even eventually the equity beta is also going to change, right? So what we should essentially do is we first get the equity beta of, right? So we get the equity beta of listed company. Then we simply get it converted to asset beta of listed company, right? And then again from this, so we have like equity beta of listed company getting converted to asset beta of listed company. And then we get just converted to, from asset beta of listed company, we obtain the, we take this replica. This is taken as the replica of unlisted company because the line of business is same. So when you have the line of business, when you are into the same sector, same industry, you can definitely take the beta as the unlisted of the listed company asset as your company asset beta, and this is also called as a proxy beta. Okay, so once we have got the proxy beta number, right? Once you've got the proxy beta number, then what we go ahead and do is we simply take up the, this proxy beta, this replica of unlisted company beta is converted to equity beta of unlisted company. Right, so equity beta of unlisted company. So equity beta of listed company will be used to get it converted to asset beta of listed company. And then that asset beta will be taken as a replica for our business. And then we compute the equity beta by using the same levered and unlevered beta calculations. Okay. So these are some of the cash flow based approach where when we want to compute the equity beta, we have to use this particular route. Then apart from that, we have got some other simple valuation techniques also, like called as the relative valuation, right? So we'll discuss about those relative valuation also later on. Let me just get started with some practical questions based on what we have covered till now. Okay. Okay. So let's get started with the practical questions. So we'll look at let's try to do it with this question number 1, guys. try to solve this question 1. ABC company is considering acquisition of XYZ Limited, right? So one of the main reasons which we do why do we do the business valuation is to get the value of the business for acquisition, for mergers or acquisition, right? It's because when I'm going to acquire another company, I need to pay a price for it. So what should be the price that I should be paying? That's what we are really looking at over here. So ABC company is considering acquisition of XYZ Limited, which has 1.5 crore shares outstanding and issued. Okay, so we've got like 1.5 crores shares outstanding. Market price per share is 400 at present. ABC's average cost of capital is 12%. The weighted average cost of capital is given as 12%. Available information from XYZ indicates its expected cash accruals for the next 3 years are as follows. So cash accruals for next 3 years are going to be like this, wherein we have year 1, 2, 3. And the cash flows are like 250, 300 and 400. Okay. So based on these cash flows, we have to obtain the value. So calculate the range of valuation ABC has to consider. Present value factors for 12 years for year 1, 2, 3 are already given to us. Now it's very simple technique. Based on market price, we can obviously calculate the value of the business. Okay, so market price per share is given to us, right, guys? So market price per share is 400, right? Then what will be the value of total business? Value of total business would be simply the market value of the company, right? Market value of the company. So market value of the company will be like market price per share into number of equity shares. So market price per share is 400 into number of equity shares is like 1.5 crores. Right, so this is like 400 into 1.5 crores. So the valuation that we get based on market value is 600 crores, right? Now, based on discounted cash flow, valuation based on discounted cash flows. So this particular valuation based on discounted cash flow, we can simply write down the cash flows along with the year. So here cash flows, the discounting factor, the PV factor, and then we take the PV. So this is going to be for like 3 years. So for 3 years, it's going to be cash flow is going to be 250, 300, and 400. The PV factors, we just need to multiply the PV factors, which is given to us as 0.893, 0.797, and 0.712. So 0.893, then we have 0.797 and 0.712. So PV is cash flow multiplied by PV factor. And then we take a sum of it. So it is like 747.15. It is the total value of the business. So what would be the value per share? So value per share would be 747.15 divided by 1.5. So this will be 740 divided by 1.5, which is 498.10. Right? So we can simply say that what could be the maximum value and what could be the minimum value. On a per share basis, the maximum value could be 498 and minimum value which we can offer is 400. And from the entire company perspective, maximum value that you can get is 747.15 crores. And this is going to be 600 crores. Right. So we can just decide the market value of the entity based on, the value of the entity based on market value and also on the basis of present value of cash flows, right? So you generally would have a negotiation between these two particular things, right? So it's like the minimum value that you should fetch for your business is 600 crores, and the maximum that anyone may offer for your business is 747.15 crores, right? Okay, so that's the question number 1. Let's go ahead with question number 2 now, guys. Let's look at this question number 2. Eagle Limited reported a profit of 77 lakhs after 30% tax for the financial year 2011-12. Okay, so after this is basically your profit after tax. An analysis of the accounts revealed that income included extraordinary items of 8 lakhs. So your income includes extraordinary item of 8 lakhs and an extraordinary loss of 10 lakhs. The existing operations, except for the extraordinary items, are expected to continue in the future. In addition, the results of the launch of new products are expected to be as follows. Sales 70, material cost 20, labor cost 12, and fixed cost is 10. You are required to calculate the value of the business given the capitalization rate is 14%. Right, so you want to get the value of the business using this concept of capitalization. So now this we have just observed how do we use that capitalization for. So for using this capitalization method, we need to compute the future maintainable profit. Then determine the market price for equity shares with the Eagle Limited's share being comprised of 1 lakh 13% preference shares, 50 lakh equity shares of rupees 10 each, and a P ratio being 10 times. Okay, so that's the second part of the question. Let's first look at the first part. So, question number 2. We have a sales, material cost, labor cost, and fixed cost given to us, right? And of course, we have also obtained the profit before taxes given to us. So, let's talk of initially the sales, right? Let's talk of the sales. So we have like 70 lakh sales. Sales is 70 lakhs. From that, we are going to reduce the material cost, labor cost, and the fixed cost. So less material cost, less labor cost, less fixed cost, right? So material cost is that is going to be 20 lakhs, labor cost 12 lakhs, and fixed cost of 10 lakhs. Right, so 20 lakhs, 12 lakhs, and fixed cost of another 10 lakhs. So this is going to be a sum of this total to 70. From that, I need to subtract 42. So when I subtract that, we are definitely going to get the profit before tax, right? This is going to be 70 minus 42, right? So this is like we are looking at the profit from a new product or new project, right? So this is the profit from new product, but it's not that we are just going to deal with this product. We have got multiple products in our business. We've got multiple products in our business. So I need to take that into account. And calculate the future maintainable profit. So for getting the future maintainable profit, I need to add to this future maintainable profit of my current business. right? So for my current business, so we have like PAT from current business. So PAT from my current business is 77, right? Can we get the PBT from current business? Yes. PBT from the current business would be simply 77 divided by 70%. This is nothing but 77 divided by 70%, which is 110. From that, you're going to subtract extraordinary income, right? And we are going to add the extraordinary expenses, because these are the expenses or income which are not maintainable in future. So we are going to eliminate their impact, right? So we need to eliminate their impact. So this revealed the income included extraordinary item of 8 lakhs and extraordinary loss of 10 lakhs. So whatever is the extraordinary income, from that you're going to reduce this. And because this income is not sustainable, right? And also the extraordinary expenses or losses that we have, that we need to add back, because these are also not something which are going to recur in future. So we take a figure as 112. This is our future maintainable profit, or future maintainable profit. I can say this is before tax future maintainable profit from current business. Okay, so 112. So this is a current business, and this is from the new product. Okay, and then finally we have like PBT of the business. So PBT of the business would be like this: 112 plus 28, right? From this, we are going to subtract the tax. It is given as 30%, right? So on 140, we are going to pay 30% tax. So we are paying out 42. Right? We're paying out 42 as a tax. And then we have future maintainable profit, or I can say after tax future maintainable profit. This is simply going to be like 98, right? So future maintainable profit is 98 from this typical business, which is a combined business of existing and the new business also, right? And then we take the capitalization factor, because the capitalization rate is given as 14%. So I can say value of business is after tax future maintainable profit upon capitalization rate. The after tax future maintainable profit is 98, and then the capitalization rate is 14%, right? So you can simply say that it is 98 divided by 14%, which is 700, right? The business value is going to be 700. Right? So value of business is simply going to be 700, which is 98 divided by 14%. Correct? That's the first part. Now the second part is determine the market price per equity share with Eagle Limited comprising of this many number of shares of preference shares and equity. So for that, we'll take future maintainable profit after tax, which is 98, right? And this is 98 lakhs. From that, we are going to reduce the preference dividend. Then the preference dividend would be like 1 lakh shares of rupees 100 each, right? So preference dividend is going to be 1 lakh into 100 into the rate is 13%. 1 lakh into 100 into 13%, right? And of course, this is since it is in lakhs, so 13 lakhs would be subtracted as the preference dividend. Now, after subtracting 13 lakhs from the future maintainable after tax profit, we get the net profit for equity shareholders. Net profit for equity shareholders, right? Now, this net profit for equity shareholders will be 98 minus 30, which is 85 lakhs. Okay. Now, this particular 85 lakhs, which is a net profit for equity shareholders, this is going to be divided by the number of shares. Right? So, number of equity shares. The question says that there are 50 lakh equity shares. So, 50 lakhs is the number of equity shares. And what will be the EPS? EPS would be 85 divided by 50. Right? So, 1.7 lakh, 1.7 is the earnings per share. But the question also gives us the P ratio. The P ratio being 10 times. So, if the P ratio is 10, we can simply say market price per share would be 1.7 into 10, which is 17 rupees. Right? So, market price per share is 17 rupees. Right, guys? So, that's this question number 2.
EPS won't be lakh.
Yeah.
EPS won't be in lakh.
No, EPS won't be in lakhs. Sorry. EPS will be 1.7. Okay. So that's a pretty simple question. Question number 2. So we're like building up the chapter slowly and steadily. So initial questions are bound to be something which is easy to do, right? And as we go ahead, we'll learn the advanced concepts also with the subsequent questions coming up. Okay. Now let's go for another question, which is the next one, which is question number 3, guys. Let's have a look at this question number 3. ABC company is considering a new sales strategy that is going to be valid for the next 4 years. Right, so new sales strategy is going to be adopted, which is going to be valid for a period of next 4 years. They want to know the value of the new strategy. Following information relating to the year which has just ended is available. So sales is 20,000, gross margin 20% is 4,000. Administration and selling expenses. Then we have profit before tax. Tax balance sheet information is that we got a fixed asset, current assets, and equity of 12 lakhs. Now, what will happen if the company adopts a new sales strategy? So the question says if it is going to adopt a new strategy, sales will grow at a rate of 20% per year. So sales is going to grow at a rate of 20% per year for 3 years. Right? So for the next 3 years, it's going to grow at 20%, and then from 4th year onwards, cash flow will be stabilized. Now, when I say stabilized, it will be like whatever is your cash flow in 3rd year, that itself will be there in the 4th year and onwards. Gross margin ratio, asset turnover ratio, capital structure, and income tax rate is going to remain unchanged. Depreciation, they're saying it would be 10% of the net fixed assets at the beginning of the year. So whatever is the amount of fixed assets that we have at the start of the year, 10% of that would be the amount of depreciation that we'll be charging. Company's target rate of return. So the rate of return which the company is looking to earn is 15%. And we have to determine the incremental value due to adoption of the strategy. Okay, so what is the incremental value that we are generating due to adoption of this strategy is what we are looking at right now. Okay. Okay. So let's try to first understand what is the likely level of fixed assets and current assets in the upcoming 4 years, right? Because of the execution of this particular project, right? Currently, if you look at it, we were having a PAT of this, and our target rate of return is 15%. So whatever is the extra cash flow that we have in the upcoming year, that will be due to the adoption of this strategy. So what we would like to have an approach for solving this question would be, we would like to first get the value of the company before the execution of strategy, and then we will say what is the value of the company after the execution of the strategy, right? If the value of the company after execution of strategy is greater than the value of the company before execution of strategy, if the value increases or if the value is higher than the before stage, then obviously it makes sense. Otherwise, we will say that the strategy should not be implemented. So we would like to first have the projected balance sheet. Right. So projected balance sheet would be like year 1, year 2, year 3, and year 4. So we have like fixed asset, current asset. So fixed asset would be, how do we compute the fixed asset in upcoming year? How do we compute the fixed asset? Now, why are we computing this projected balance sheet or projected fixed asset and current asset? Because we want to know, what will be the cash flows that will be generated. Because any increase in fixed assets will be definitely be a cash outflow, right? So the question says gross margin ratio, asset turnover will remain unchanged. Now, when you say asset turnover, what is the current asset turnover? For a sales of 20,000, we have a fixed asset of 8,000 and current asset of 4,000. So of course, this fixed asset is simply 40% of sales, and this is 20% of sales, right? So 40% of sales and 20% of the sales. So I need to know what are the values of sales, right? Because based on the sales only we can get the values of fixed assets and current assets. So of course, to get this fixed asset and current assets, I need to compute the cash flows or the sale values also. So first we need to take the projected cash flows. Projected cash flows would be, start with sales figures. Sales is 24,000, right? So initial sales, because it's 20,000 and there is going to be a growth of 20%. So since there is going to be a growth of 20%, so it will be 24,000 into 1.2. Then this is 28,800 into 1.2, and then this also multiplied by 1.2. So every time it is increasing by 20%, but except for the fourth year, because in the fourth year the question says that this is going to be there for 3 years, and then from fourth year onwards it's going to get stabilized. So fourth year sales is going to be like 34,560 itself, right? And then its fixed asset is simply going to be 20% of sales, right? So 20% of the sales figures. So fixed asset value from the sales, we can say it's 24,000 into 20%. So fixed asset, sorry, is it 20%? No, it's 40%. Fixed asset is 40%. Sorry. 40%, right? So this is like 9,600, 11,520, 13,824, and 13,824 even for the last year. That's the fixed asset value. Current assets are 20% of sales. Current assets are 20% of sales. So 24,000 into 20%. Right. So everything is like, we got the total 20, the percentage of sales figures. So we got the fixed assets and the current assets. And if you look at the balance sheet specifically, there were like fixed assets 8,000, current assets 4,000. Equity, it was just 12,000. So there is no other debt in the company. So this is like a totally ungeared or unlevered company, right? So we can say that the total assets would be a sum of these two, right? And then equity will be, of course, equal to the total assets. So total assets is 14,400, 17,280, and then equity is of this particular thing, right? So equity is also going to be the value of total assets because there is no debt left in the company. Okay, so we have got the sales. Now from this, I need to arrive at the cash flow, free cash flow for the firm. So for that, we need to first get the profit before tax. So as far as profit before tax is concerned, you can see gross margin is 20%, admin expense is 10%, and of course my PBT, which is coming out to be 2,000, I can simply take that PBT is nothing great other than the 10% of the sales, right? So you can see this particular PBT is 10% of the sales figures, right? So PBT is simply going to be 10%. Right, so this is going to be 24,000 into 10%. Right, so 24,000 into 10%, 28,800 into 10%. So this is our profit before tax numbers. And of course, from that, I need to subtract the tax. So the tax rate that we have is 30%. So let's subtract the tax. And then we get the profit after tax. So profit after tax will be 2,400 minus 720. Right, so these are the profit after tax figures. Right, so these are the profit after tax figure. Now, based on that, we have to get the depreciation. Right, so depreciation is something that we need to add back because we want to obtain the cash flow, right? So I need to add depreciation. Now the depreciation amount, as the question is stating us, depreciation would be 10% of net fixed assets at the beginning. So whatever is the amount of fixed assets at the beginning, we're going to have a 10% of that. Now in year one, at the beginning, we had a fixed asset of 8,000. We had a fixed asset of 8,000. Now that on that 8,000, you have got the 10% as depreciation. So that will be 800. Then for the next year, it's going to be 9,600 into 10%, which is 960. And same way, it's going to be 10% 1152 and 1382.4. That's the depreciation value. Right? So we need to add back the depreciation because depreciation is not a cash expense. Then we need to subtract the addition to fixed asset. We need to subtract the addition to the fixed asset. Now, how would we get the addition that we are making to the fixed asset? What is the increase in the fixed asset that we have? So the increase in the fixed asset, the addition that we are having in the fixed asset, wherein we are putting in the additional money into acquiring the fixed assets, what would be that amount? Anyone? Can you tell me what will be the investment in fixed assets in first year?
Minus 8,000.
Because in year 0, it was 8,000 and year 1, it's 9,600 fixed asset. So can I write here as 1,600?
Yes, sir.
Yes or no?
Yes, sir.
No, we can't write 1,600 over here because remember, this 9,600 or 11,520, these all are the after depreciation figures. So I need to know what is the amount of addition that we're making to the fixed asset. So let me just do it with the form of a working note for your understanding. Working note is like purchase of fixed asset. Purchase of fixed asset, right? So let's say year 1, year 2, year 3, and year 4. Year 1, 2, 3, 4. Now for these years, we have like fixed assets. We've got a purchase of fixed asset year 1 to 4. So first we need to look at what is the opening value. So year 1, the opening value is 8,000. And then from second year onwards, you have like 9,600, 11,520, 13,824. That's your opening value, right? Now we are obviously having depreciation, which is this 800, 960, 1152, 138. There is 10% of the opening balance, right? And after that, we are having the closing balance. So when you are going to, like, take the opening, you reduce the depreciation, and from that you are going to further subtract the closing WDV. That's going to be like 9,600. That now, if you do this calculation, like 8,000 minus 800 is a depreciation gone, and you have like 9,600 in the closing balance. So what is the cash flow for fixed assets? So for fixed asset, you have like 8,000 minus 800 minus 9,600. So you are like spending 2,400 for acquiring the fixed asset, right? And the same thing applies for the other thing also, right? So it's simply like you're preparing a ledger where you have an opening balance of 8,000, you have a closing balance of 9,600. There is a depreciation of 800. So what would be this balance? That is what we are looking for. The expense that we are spending, the money that we are spending for acquiring the fixed asset, right? So the fixed asset is going to be computed in this manner. Is this clear, everyone?
Yes, sir, clear.
Yeah. So this was something a bit different. You cannot simply take the difference in the fixed asset because those are the ending fixed assets. So addition to fixed assets would be like this 2,400, or let me just write it as these numbers itself, right? And so we have like PAT, to that we have added depreciation, to that we have added the fixed asset. And also one more thing that we need to look at is current assets. So current assets is also increasing. So we will say less addition to current assets. So when we're looking at current assets, initially it was current assets was like 4,000. Now from 4,000 it has become 4,800. So the addition to current assets that you are spending is like 4,800 minus 4,000, so 800. So here we have like the difference between the year 2 and year 1 values as addition in current assets. Then it's 1,152. And of course, in the final year, there won't be any addition to the current assets because sales has remained same and there is no change in the current assets, right? One typical point I would like you to note is when the cash flows are getting stabilized, the depreciation and addition to fixed assets, if you look at that, depreciation and addition to fixed assets, they are offsetting each other. Depreciation and addition to fixed assets are offsetting each other, right? So just keep this in mind. We may recall it at a later point of time. When the cash flows are getting stabilized, when there is no growth in the cash flows, the depreciation and fixed assets can be said to be offsetting each other. Okay. So that we have the addition in to the current assets, and then we have free cash flow for the firm. Right, so let us say PAT plus the depreciation plus the addition to fixed assets plus the addition to current assets. Okay, so here we have the negative cash flows. Free cash flow from the firm turns out to be negative. Now let's get the present value of these cash flows by simply multiplying it with the PV factors, right? So PV factor, have the question given as a PV factor? No. Okay, at the rate of 15%, the PV factor for first year would be 0.870. This would be like 0.756, and for this it is 0.658, right? So these are the PV factors that we have. Then of course we'll need to have the terminal value also. So PV of free cash flow for the firm from year 1 to 3. This is simply going to be minus 626, minus 653, minus 682. Right? Correct. So these are the PV factors. Now we also need to get the terminal value. Terminal value. So terminal value is simply going to be residual value or the terminal value. Now there is no growth in it. So if there isn't any growth, we can say free cash flow, or this is terminal value in year 3. This is going to be free cash flow for the firm in year 4 upon KO. So free cash flow for the year 4 is this, and KO is like 15%. 2419.2 divided by 15%, which is 16128. Right? Now, of course, I need to get the present value of the terminal value, which is 16128 divided by 1.15 to the power of 3. Right, so this is like 16128 divided by 1.15. So 1.15 to the power of 3. So we can say the value in terminal value terms is 10,604. Right. So what would be the value of the company, or total shareholders value? Total shareholders value post strategy. After execution of the strategy, what is going to be the total value? So this is going to be like minus 626, minus 653, minus 682, and then plus 10604. Right. So this gives us like sum of, it's like 8642. That's the value of the shareholders after the strategy. So after the strategy has been executed, we get the value as 8642. Now, of course, we want to know whether this strategy should be implemented or not. For that, I need to get the pre-strategy value. Pre-strategy value. Now, for pre-strategy value, it's going to be like PAT is 1400. 1400 divided by 15%. Right? So PAT is 1400 divided by company's target rate of return is 15%. So 1400 divided by 15%. So 9,333 is the value which we have pre-strategy, and post-strategy the value is 8642. So after execution of my strategy, the value is reducing to 8,642. In fact, before strategy, I was better off with 9,333 being the value. So what would be the value of the strategy? Well, the value of the strategy is simply negative, guys, because it's going to be 8642 minus 9,333. So that's like 691. So the value of the strategy is 691 negative, right? So should this strategy be implemented? Should this strategy be implemented, guys? It shouldn't be, right? Because it's leading to erosion in the value. The value is getting eroded. Instead of increasing the value, the strategy is trying to put the value down, right? And therefore, this is something which we can say not at all feasible. Okay, have you got this solution, everyone? Did we understand it? Yeah. Yeah. Okay, then let's go for the next, which is question number 4. Just read this question, guys. Just give me a moment. 1 second. Just meanwhile, just you can read this question. Okay, guys. So here we have H Limited agrees to buy H Limited agrees to buy over the business of B Limited effective 1st April 2012. The summarized balance sheet of H Limited and B Limited as on 31st March 2012 are as follows. So we have like two entities, H and B. Both of them are into some sort of agreement for a merger. So H is going to buy B Limited, and the balance sheet as on 31st March is given to us. H Limited proposes to buy out B Limited, and the following information is provided to you as per the scheme of buying. So as per the scheme of buying, how are they agreeing on to this? First, the weighted average post-tax maintainable profits of H Limited and B Limited for the last 4 years is 300 crores and 10 crores. Okay. So we have got the post-tax maintainable profits, future maintainable profits for the last 4 years as 310 crores. Both companies envisage a capitalization rate of 8%, right? So both companies are going to look at a capitalization rate of 8%. Then we have H Limited has a contingent liability of 300 crores as on 31st March 2012. Right? So H Limited is having a contingent liability of 300 crores. H Limited is going to issue shares of rupees 100 each to the shareholders of B Limited in terms of exchange ratio as arrived on a fair value basis. So both the companies are looking at a capitalization rate of 8%. H Limited, that is this particular company, the company which is going to acquire the other, is having a contingent liability of 300 crores. Then H Limited is going to issue shares of 100 each to the shareholders of B Limited in terms of the exchange ratio as arrived on a fair value basis. So we need to obtain the fair value of the share. Now, fair value, how do we determine? They say, consider the weights of 1 and 3 for value of shares arrived on net asset basis and earnings capitalization method. So we have to obtain the value of two shares based on two methods. One is on the basis of net asset and other is on the basis of earnings capitalization. You're required to arrive at the value of the shares of both H and B under net asset value method, earnings capitalization method, and then the third is exchange ratio of shares of H Limited to be issued to the shareholders of B Limited on a fair value basis, taking into consideration the assumption mentioned in point number 4 above. Okay. Fine. So we have to arrive at this exchange issue. First, we need to get the value of the shares using NAV method. So let's get started with this. It's actually a question similar to that of a mergers and acquisition. But yes, exchange issue is what we're going to calculate. So value of shares using net asset value. Right. So using net asset value, we can say one is for H Limited, another is for B Limited. Okay. So we have like total of assets as 1300 and for B it is 31.5 crores, right? So let us say total assets for H Limited, it is 1300, right? Total assets is 1300 and for this it is 31.5. Now, any sort of debt, is the company having any debt? No, both the companies are ungeared, both the companies are not having any amount of debt. So I cannot subtract any debt as such. But yes, one thing I can subtract, and I have to subtract, is the contingent liability. Because this is something which is payable. Right? It's something which is payable. So contingent liability is going to be like the amount of contingent liability is 300 crores. So contingent liability is 300 crores. There's no contingent liability over here. So we can say net assets is simply over here 1000 and here it is 31.5. Right? This divided by number of equity shares. So number of equity shares is over here it is 3.5 crores. And for B Limited it is number of equity shares is 6.5 crores divided by 10. That will be 0.65 crores. Right? And then we get the net assets divided by number of equity shares is going to be net asset value per share. So we arrive at the value as 285.71 and 48.46. Right? The value of shares using net asset value. And then we have earnings capitalization. Second method is earnings capitalization. Now, for obviously earnings capitalization, I need to take the earnings, capitalize it to get the value of the share, and then divide it by the number of shares to arrive at the value per share. Right. So this is like earnings capitalization is, for that we need to take the earnings figure. So earnings are future maintainable profits are given to us. So future maintainable profits are 300 crores and 10 crores. So 300 and 10 crores. Right. Then we have like capitalization rate. So the capitalization rate is given to us to be 8%. So both the companies' capitalization rate is 8%. Right, and then we have the value of the company. So value of the company will be like 300 divided by 8% and 110 divided by 8%. Right, so we have like number of equity shares. So number of equity shares is 0.65 and 3.5. Right, so based on that, we can get the value per share as 1071.429 and 192. Right, so we got this value per share on the basis of equity capitalization method. Now it's time for us to obtain the fair value. Right, so we have to obtain the fair value. So we have like calculation of fair value. So for calculation of fair value, we have like we'll have to take the weightage. So let me take it as H limited and B limited. Right. So weights, we need to look at the weighted average number based on the net asset value and equity capitalization, wherein a weightage of 3 is to be given to the equity capitalization. Right, so earnings capitalization rate is going to be 3 and the net asset is going to be 1. So calculation of the fair value is going to be on that particular weightage. So let us say we take the weights and then we say weights into H value and of course weights into the P value. Now the weightage has been given to us. I mean, we have got the values as per the NAV and also as per the equity capitalization. So NAV is 285 and for B it is 48.46. Equity capitalization is 1071 and this is 192. Now the weightage that we have to give for net asset value is 1 and here the weightage is 4. Right, not 4, 3. So we can simply say H into weightage and H into the second weightage. Right, so we take a sum. 3,500 is a sum, but of course we also have a weight of 4 over here. Right, so fair value of H limited. Fair value of H limited is 3,500 divided by 4, which is 3,500 divided by 4, 875. Same way, I have to get the fair value of B limited. Fair value of B limited is weights multiplied by B right. So this is going to be 625.38, 625.38 divided by 4, 625.38 divided by 4, which is 156.3462. So this is what we got the fair value of both the companies. Right, for fair value for we have got the fair value for H as well as for B. Right, so now once you have got the fair value, the question says what should be the exchange ratio of H limited to B issue. Now H limited fair value is 875, B limited fair value is 156. So exchange ratio will be 156.35 divided by 875, which is 0.1786. What is the meaning of this 0.1787? This simply means for one share of B Limited, 0.1787 shares of H Limited should be issued. So for every one share of the target company, the acquirer company is going to issue 0.1787 of its shares, because obviously shares of H Limited are having a higher value than that of B Limited. Okay, is this clear? Is this thing clear, guys? Yep. Okay, so this was like getting the valuation based on a fair value basis, and for that fair value, we take a weighted average of the book value and the equity capitalization rate. Okay, that's question number 4. Now let's take up the next question, which is question number 5. Question 5, guys. AB Limited is planning to acquire and absorb the running business. So it's like an ongoing entity, a going concern entity, XY Limited, which we are planning to absorb. The valuation is to be based on the recommendation of merchant bankers, and the consideration is to be discharged in the form of equity shares to be issued by AB Limited. So we are going to issue equity shares to the target company. As of 31st March 2006, the paid up capital of AB Limited consists of 80 lakh shares of rupees 10 each. The highest and the lowest market quotation during the last 6 months were 570 and 430. For the purpose of exchange, the price per share is to be reckoned as the average of highest and the lowest market price during the last 6 months ended on 31st March 2006. Okay, so XY Limited's balance sheet as on 31st March 2006 is summarized as below. So remember, as on 31st March, the paid up capital is 80 lakhs. The highest and the lowest market quotation that we have is given. For the purpose of exchange, now this is something relevant. The price per share is to be reckoned as the average of the highest and the lowest market price, right? So price per share of AB Limited is going to be highest and it's going to be average of the highest and lowest. So let me say price per share of AB Limited, right, is going to be average of highest and lowest. So average means 570 and 430. 570 plus 430 divided by 2, right, which is simply going to be 500. Okay. XY Limited's balance sheet as on 31st March 2006 is given to us. So we have like share capital. So there are 2 types of share capital. One is the 20 lakh share equity shares of rupees 10 each, fully paid up, and the other is having a paid up value of 5. Okay, then in the capital we have got loan of 100, fixed asset, and the net current assets. Total balance sheet size is 350 lakhs. Then, as an independent firm of merchant bankers, we have been presented with the financials, engaged for negotiations, have produced the following estimates of the cash flows. So 31st March 2007, 8, 9, 10, 11. So these are like, we have got the after-tax earnings for equity ranging from 105 till terminal value estimate of 200. And like it's from 7 to 11, they have given us the information. It is recommendation of the merchant banker that business of XY may be valued on the basis of average of. So we are going to take a average. average of aggregate of discounted cash flow at 8% and net asset value. So we need to take the discounted cash flow and also the NAV value, and we're going to take the present value factor at 8%. You're required to calculate the total value of the business of XY Limited, number of shares to be issued by AB Limited, and basis of allocation of shares among the shareholders of XY Limited. Okay. Now, okay, so we need to first get the price of shares is what we have given, which is 500. Now, value of XY Limited based on the future cash flow. Value of XY Limited based on future cash flow, right? Based on future cash flow, we have like year cash flow, PV factor, and then we take the PV. So we have like here 1, 2, 3, 4.
Excuse me, sir.
Yeah.
Sir, the assignment you are using, we don't have the assignment, this one.
You will be getting it by today. So this is a module question only. This module question number 5. You can refer
Okay,
all the time.
okay. Okay, sir.
Yeah. Okay. So here 1 to 4 we have the cash flows, which is obviously after tax earnings for equity. Now, since there is no information regarding the depreciation or in fixed asset investment or current asset investment, we are taking this as a proxies for the cash flows. So we have like from 2007, so 1, 2, 3, 4, 5 years are available. 5-year cash flows. The cash flows are like 105. Then we have 120, 125, again 120. Then we have 100, and also a terminal value of 200. Right. So we need to take the present value factors. Now, present value factors are given to us 0.93, 0.86. So let's take those present value factors: 0.93, 0.86, then 0.79, 0.74, 0.68, and 0.68. Now the PV is cash flow multiplied by PV factor. Right, so let's take a sum of it, which is 592.4. So value of XY Limited based on future cash flows is 592.4. Okay, so XY Limited, the present value is simply 592.4. But we also need to take the value of XY on the basis of NAV. So value of XY Limited based on NAV. So based on net asset value, we can say the net asset value is simply total of assets is like 300 minus the 100 loan. So this is 350 minus 100, which is 250. Right? So net asset value is going to be 250. Right? So it's a recommendation of merchant banker that we need to take the average of discounted value and the net asset value. So we're going to take the average. So we say average value of XY Limited, which is going to be 592.4 plus 250 divided by 2. Right, so that will be, we take an average of 592.4 and 250. So we get it as 421.2. So average value is 421.2. This is so many, of course, in lakhs, right? Now I need to divide it by the number of shares, right, to get the value. Now, Of course, one thing that we need to really be looking at is number of shares in AB Limited which we need to issue. That will actually depend on the relative valuation of both the companies. And we are like, during the last 6 months, we had like 570 and 430 value, and we obtained the average value to be 500, right? We obtained the average value to be 500. So the per share value has been obtained. Now here I cannot obtain the per share value for this target company because there are two types of shares in it, right? So we have definitely got the value of XY Limited based on the total business value. Now I need to get the number of equity shares of XY Limited to be issued, which will be 421.2 divided by the number of shares which are going to be issued. Each share is valued at 500. So 421.2 lakhs divided by each share is worth 500, right? So how many shares are we going to divide by 500? We are going to issue like 84,240 number of shares that we are going to issue to the shareholders of XY Limited, right? The number of shares of not XY but AB Limited to be issued to shareholders of XY Limited. So we have to issue like 84,240 number of shares to be issued to the shareholders of XY Limited, right? Now, out of this, out of 84,240, how many shares are we going to issue to the fully paid up one and to the partly paid up one, right? So the ratio, if you see from a value perspective, from the total value perspective, out of total capital of 250, 200 belongs to the fully paid up share capital and 50 belongs to the partly paid up share capital. So number of equity shares to be issued to fully paid up shareholders. Number of equity shares to be issued to fully paid up shareholders. It will be like 84,240. You divide it by 250, right? And then multiply with 200. So this multiply by 200. So 84,240 divided by 250 multiply by 200, which is 67,392. Right? What will be the number of equity shares to be issued to partly paid up shares, to the partly paid up shareholders? If you look at the partly paid up shareholders, I can say since it is 84,240, out of this 84,240, we are issuing 67,392 shares to the fully paid up one. So to the partly paid up one, it will be the balance number of shares which will be issued. Right. So 16,848. Right. That's how you decide the shares to be issued to fully paid up and partly paid up shares. Okay. So are we good with this now, everyone? Yes. Are we clear? Yes. Okay. Then let's do one thing before we go for subsequent questions, or rather I'll say let's try to complete this question 6 and then after that we'll take a break. Okay, let's complete this question 6 guys first and then we'll take a break. So question number 6, it's a very small question, but yes, quite an interesting question. Valuation of Hansel Limited has been done by an investment analyst based on expected free cash flow of 54 lakhs. So we have the free cash flow for the firm as 54 lakhs and an expected growth rate of 9%. Growth rate of 9%. And the analyst has estimated value of Hansel Limited to be 1800 lakhs. However, he committed a mistake of using book values of debt and equity. Now, this idiot, the investment analyst, what he did is, while calculating the estimated value, he has committed a mistake of using book values of debt and equity. Whether in real life situation, we always take the weighted average on the basis of market values. The book values employed by the analyst are not known. Okay. But you know that Hansel has a cost of equity of 20% and post-tax cost of debt is 10%. Okay. The value of equity is thrice its book value. So whatever is the book value of equity, the market value is going to be 3 times of it. Whereas the market value of its debt is 9/10 of its book value. So whatever is the market value of the debt, out of that we have taken it as the market value is basically 9/10 of it. So we need to adjust it. We need to adjust this to arrive at the correct value of the Hansel Limited. Okay, so this growth rate is 54, FCFF is given. So we simply know that value in year 0 will be free cash flow for the firm in year 1 upon overall cost of capital, KO, minus the growth, right? So now value that has been arrived is 1800, right? So this is 1800. So we can say, sir, 1800 is equal to FCFF for year 1 is 54 divided by 9% minus growth rate. Growth rate was 9%, and we don't know what is the KO, right? So we can say KO minus growth rate is 9%. Okay, so 1 second. Yeah, we have like the book value weights employed are not known, but you know that Hansel has a cost of equity is 20% and cost of debt is 10%, right? So we already have this typical number of growth rate being 9%, right? So growth rate is basically given to be 9%, whereas cost of debt and cost of equity are given to us. Now we don't know what is the real value of KO. So let's first try to get the KO value from this. So if we solve this and try to get the KO, we can say KO minus 9% is equal to 54 divided by 1800, right? So KO will be simply 12%. So overall cost of capital is 12%, right? Now, since we have this 12%, we don't know what is the weightage that have been used, right? But we know that weighted average cost of capital is going to be computed as weight of equity into the cost of equity is 20% plus 1 minus weight of equity into 10%. Okay, so weighted average cost of capital is 12%, guys. So we can say that here it is weight of equity into 20% plus 10% minus weight of equity into 10%. So 12% is equal to now this particular number, we can say weight of equity into 20% minus weight of equity into 10%. That will be like weight of equity into 10% and 10% going on the other side will be left as 2%. So that will be like 2% equal to this. So we get the weight of equity to be 2% divided by 10%. So we get the weight of equity as 0.2. Right. So originally we get the weight of equity as 0.2. Of course, the weight of debt is going to be 0.8. Now we need to rearrange this. We need to change the weights, right? So revised weight of equity. Revised weight of equity will be like 0.2 into 3 because it's going to be 3 times, right? Right. So correct weight, we can say this is like the value of equity is thrice its book value. So thrice its book value, when you say, it's going to be 0.2 into 3, which is equal to 0.6, and then revised weight of debt. Revised weight of debt will be 0.8 into this is 9/10, right? So this is like they stated it to be 9/10 of its book value, so into 9 by 12. So this will be 0.8 into 9 by 12. So that is 0.6. So 9/10, my bad. It's 9/10. 0.72. So you can say it comes out to be total 1.32. It comes out to be 1.32. Now, if I want to get the revised weighted average cost of capital, I need to write down the cost over here. So cost of equity is 20% and cost of debt is 10%. So we just need to take the weights into cost, which is 0.6 into 20%, and then this. Then we take a sum of this. So we got the revised WACC. Revised weighted average cost of capital will be 0.192 divided by 1.32, which is 14.55%. Right, 14.55%. That's a revised weighted average cost of capital, 14.55%. Then we are like, we want to value the correct valuation. The correct value of business will be free cash flow for the year 1 upon KE minus G. Free cash flow for the year 1 would be 54 lakhs upon KE minus G. KE is 0.1455 minus growth rate that they have given us in the question is 9%. So 0.09. So this is simply going to be 54 divided by 5.55%. So the correct value should be 973.77 lakhs. So the correct value of the business should be 973.77 lakhs. Okay, so that's how we arrive at the value by revising the weights and other aspects. So we have done like question number 6. Now let's take a break now. Okay, let's take a break of 10-15 minutes, and then we'll come back and do some more questions on the business valuation. Okay, so let's take a break, guys. So we were into the business valuation. We've just done this question number 6. Now it's time for us to look at some more really interesting questions. So let's look at this question number 7. Okay, let's look at this question 7. Following information is available in respect of XY Limited, which is expected to grow at a higher rate for 4 years, after which the growth rate will stabilize at a lower level. Okay. So we are going to have like a high growth rate for 4 years. After that, it's going to get stabilized. Okay. So base year current information that we have is regarding the revenue, which is revenue 2000 crores, EBIT of 300 crores, capital expenditure of 280 crores. Okay. Depreciation is 200 crores. The information for high growth and stable growth period are as follows. So we've got the information about the high growth and the stable growth phase. So high growth is like growth in revenue and EBIT is 20% and stable growth is 10%. So during high growth, we are going to have a growth rate of 20%, whereas during the stable growth rate, it's going to be 10%. Growth in capital expenditure, so capex is going to grow by 20% every year. And in stable growth rate, they are saying capex will be offset by the depreciation. Right? So whatever is the capex, that's going to be offset by the depreciation. Basically, in one of the questions that we have seen, in one of the past questions, I'll just show you. Where is it? Yeah, this is what we were observing. Then the third question, that the amount of depreciation which we were adding back, that is the same amount of fixed asset which we were purchasing. So that is what they mean by the offsetting by each other in the stable growth. Okay. Risk-free rate is given as 10% and 9%. Equity beta is given. Market risk premium is given. Pre-tax cost of debt is given. And debt equity ratio is also given as to what will be the debt equity ratio during high growth and stable growth phase. For all time, the working capital is going to be 25% of the revenue and corporate tax rate is 30%. So we want to know value of the firm. So we want to know what is the value of the firm. Okay. So this is question number 7. Okay. So the first thing that we need to calculate is during the high growth phase, what is going to be the overall cost of capital, and during stable growth rate, what is going to be the cost of capital. High growth phase and stable growth phase, right? So during high growth phase, the cost of equity will be determined using this risk-free rate, equity beta, and market risk premium, right? So this is going to be like risk-free rate is 10%. So that's 10% plus beta of 1.15 into pre-tax, or sorry, market risk premium is already given to us as 6%. So we can simply say multiply this by 6%. So we get the K as 10% plus 1.15 into 6%. So, oh, sorry. Where is this? Yeah. So K during high growth phase is 16.9%, and during that phase we have the pre-tax cost of debt as 13%. So pre-tax cost of debt is 13%, and what's the tax rate? tax rate is capital expenditure. What is the value of the firm? Corporate tax rate is 30%. Okay. So post-tax cost of debt will be 13% into 1 minus 0.3. So that is like 13% into 1 minus 0.3, which is 9.1%. Right. So post-tax cost of debt is 9.1%. Now we need to get the overall cost of capital. So KO is weight of equity into cost of equity plus weight of debt into cost of debt. So weight of equity into cost of equity, we have like weightages, debt equity ratio is 1:1. And so since it is 1:1, we can say it is 0.5 into 16.9% plus 0.5 into 9.10%. Okay. So we have the overall cost of capital as, sorry guys, overall cost of capital is 13%, right? So KO is 13% in the high growth phase. So during the high growth phase, KO is 13%. During the stable growth phase, we see the same way we need to get the cost of equity. For that, risk-free rate is 9%, which is 9% plus equity beta is 1 into 6%. So K is simply going to be 9% plus 6%, which is 15%. Once again, equity premium, okay, market risk premium is also changing. So that's going to be 5%. And similarly, this is yes, 14%. So cost of equity, K is 14%. Now, what is the pre-tax cost of debt? Pre-tax cost of debt is 12.86%. So post-tax cost of debt will be 12.86% into 1 minus 0.3. Right, so which is 9.002, or you can simply say it's 9%. And so post-tax cost of debt is 9%. And finally, we can say post-tax KO will be same, weight of equity into cost of equity plus weight of debt into cost of debt. So KO is now the debt equity ratio is changing. It's not same as the earlier case. So now the debt equity ratio is 2:3. So when we say it's 2:3, the weightage will be like 0.4. So 0.4 into 14% plus 0.6 into 9%. So KO is going to be 11%. So we have KO as 11%, guys. So overall cost of capital is 11% in the stable growth phase. So we got the KOs in both the phases, stable and high growth. Now it's time for us to look for the FCFF calculation, which is free cash flow for the firm, right? So free cash flow for the firm. So for that, we'll have to simply look at the revenue, which is given to us 2,000, and then EBIT is given in the base year. So we need to grow it for that particular year and then also reach up to the terminal year value. Okay. So let's go ahead with calculation of free cash flow for the firm. So free cash flow for the firm, we can compute it with year 1, year 2, year 3, year 4. and then we have the terminal value. Revenue wise, initial year we had 2000 crores. So for year one, revenue will be 2000 into 1.2, which is 2400. And then of course, subsequent years, there is a growth of 20% every year. So we just need to multiply it with 1.2. But wait, for the final year, we don't have to grow it by 20%. Rather, for the final year, we need to make it grow by a stable growth, which is given as, which is 10%. Right. So I need to grow this by 10%, which is into 1.1. Then we have EBIT. So currently the EBIT is 300, and of course there's going to be a growth of 20% during the 4 years. So 300 into 1.2, and then the previous value multiplied by 1.2. This will go until year 4, and then in the terminal year, this is going to be 1.1 multiplication, because there the growth rate is stabilizing to 10%, right? So we got the EBIT. Now from EBIT, we need to get the earnings after tax. Now for earnings after tax, we need to simply take, because since we are calculating the free cash flow for the firm, right? Since we are calculating the free cash flow for the firm, I just need to take the after tax figure for this. So after tax payments are going to be simply okay, so we got the EBIT, but we need the after tax figure. So for that, we have the tax rate, which is 30%. So to make the EBIT after tax, we can say earnings after tax is going to be the EBIT multiplied by 1 minus 0.3. So this multiplied by 0.7. Right. So 70% is what is going to be the earnings after tax. And remember, we are here to calculate the free cash flow. We are here to calculate the free cash flow for the firm. And therefore, we are not subtracting interest and doing all those things. We're not subtracting the interest for the simple reason because we are interested in calculating the free cash flow for the firm. We want to value the business. So we got the earnings after tax as these figures. And then from that, we are going to reduce the capital expenditure and add depreciation, right? So capital expenditure and depreciation, both impacts we need to give. So let us do one thing. Add depreciation less capital expenditure. So the depreciation which we have, initially the depreciation was 200. And as the revenue is going to grow by 20%, and moreover, the growth in capital expenditure and depreciation is also given as 20%. So depreciation in year 1 will be 200 into 1.2. This will keep on growing. Sorry. Right. So this is 200 into 1.2, which is depreciation. So that depreciation is getting added 240, 288, 345.6 and 414.72. And then in the terminal value, they're saying capital expenditure are offset by depreciation. So whatever will be the depreciation over here, that same will be a subtraction in the terminal value, right? So capital expenditure initially capex was 280 crores. Now that 280 crores is going to grow by 20%. This into 1.2. Okay. So this is your amount of capital expenditure. Now, in this particular part, we will simply say this is zero. I mean, in the terminal year, your capital expenditure and depreciation are going to offset each other. So we're just going to ignore that part. Okay, because they're going to offset each other. So once we have taken this into account, adding the depreciation less capital expenditure, I need to further reduce less increase in working capital. Now, the working capital will be of course, capital expenditure and depreciation is going to grow. And initially, you have like revenue given. Regarding the working capital, they say working capital is 25% of revenue and corporate tax rate is 30%. So I need to look at the working capital as a 25% of revenue. So I need to calculate what is the change in the working capital, right? So let me just do the calculation over here in the form of a working note. Working note number 1, which is change in working capital. Year 0, year 1, year 2, year 3, and year 4. Okay, then we have the revenue. Revenue would be year 0, it was 2000, and then subsequent years, I've already computed the revenue numbers. These are the revenue numbers. Now, working capital is 25%. So it's going to be 2000 into 25%. So what is the change in working capital? The change in working capital would be, currently it is 600. Previous year it was 500. So change in working capital is 100. And then we just take this into account. Till year 4, we have like 172.8, right? So one thing you can observe, as the rate of revenue is changing, right? We also have year 5, right? So year 5 is into 1.1. Yeah. So as the rate of, the change in working capital is equal to the change in what we say, the depreciation and change in the revenue. So your working capital is changing by 20% because your revenue is also changing by 20%. So we can say increase in working capital is 100, 120, and then so on. Right. So these are the changes in working capital that we have. Now, once we have done this, now we can simply get the free cash flow for the firm. The free cash flow for the firm will be earnings after tax, add depreciation, minus capex, minus increase in working capital. So these are the free cash flow for the firm. 56, 67.2, 80.64, 96.77, and free cash flow for the final terminal value is 375.32. Okay. We've got the free cash flows. Now it's time for us to calculate the value of the business, which is nothing but present value of the future cash flows. So we can say calculation of value of business. Here, cash flow, present value factor, and PV. So here it is 1, 2, 3, 4, And then again, fourth year, we're going to write the terminal value. Okay. So we'll say terminal value will be 375.32 divided by cost of capital during the stable growth rate is 11%. So I need to simply overall cost of capital. It was 11%, right? Rate of equity, debt equity ratio, there's some problem. Debt equity ratio is 2:3. Okay, so I think the weightages have been messed up. So this is 0.6 and this is 0.4. Yeah. Yeah, 12%. 0.6 into this, and this is 0.4. Okay, fine. So 12%. So we need to divide this by 0.12 minus the growth rate. Growth rate was 10%. 375.32 divided by 0.02. 18766. Right, that's the terminal value which we have, which is 18766. Now let's look at the cash flows. Cash flows for year one is 56. This is 67.2. This is 80.64. This is 96.77 and 18766. So present value factor, obviously I'm going to discount it from fourth year onwards till now. So I need to take the high growth phase present value factor, which is 13%. The PV factor at 13%. So this is 1 divided by 1.13 to the power of number of years. Do we have the PV factors given to us? No, we can have to calculate and then get the PVs. So these are our PV factors. And then finally, the present value will be cash flow multiplied by PV factors. Right. So total value of the business will be sum of all of that. Total value of business is 11,726 crores. That's the total value of the business which we are determining. Okay. So quite an intuitive, a very elaborate question to cover, ranging from forecasting of revenue till the computation of the value of the business. Right? Sure. Fine, guys. Then let's go for the next aspect, which is question number 8. Look at this question number 8, guys. Look at this question number 8. Can you calculate the free cash flow for the firm in question number 8? Just read it and let me know if you can calculate the free cash flow for the firm. You will read the question number 8 and tell me if you can calculate the free cash flow for the firm. Can we calculate the free cash flow for the firm in question 8? Yep. Okay, so following information is given respect of WXY Limited, which is expected to grow at a rate of 20% per annum for next 3 years, and then the growth rate will stabilize at 8% per annum normal level in perpetuity. So revenue is 7,500, cost of goods sold is 3,000 crores, operating expense is 2,250 crores, capital expenditure is 750 crores, depreciation, which is included in the operating expenses, is 600 crores. During the high growth period, revenues and earnings before interest and tax will grow at 20% per annum. They say revenue as well as EBIT is going to grow at 20% per annum. And the capital expenditure net of depreciation will be growing at 15% per annum from year 4 onwards. Right? So this is like your revenue and EBIT will be growing at 20%, and capital expenditure net of revenue will grow at 15% from in the initial phase. From 4th year onwards, the normal growth period, you're doing the normal growth rate, revenue and EBIT will grow at 8%, and incremental capital expenditure will be offset by the amount of depreciation. During both high growth and normal growth period, net working capital requirement will be 25% of the revenues. So during both high growth and normal growth period, net working capital requirement is going to be 25% of the revenues. So weighted average cost of capital is going to be 15%. And we say that corporate income tax rate will be 30%. So WACC is basically given to us. We have to calculate the value of WXY using free cash flow for the firm and WACC methodology. So similar to question number 8, second, let me just reopen it. It has hanged possibly. Just 1 second, guys. Please think there's some problem. Let me just reopen it. Okay, so let's look at this question number 8. So question number 8, we have the information about the revenue, COGS, their growth rates, and we just need to take the present value. So we have information for year 1, year 2, year 3, and terminal year, which is the year 4. So we have the revenue. From that revenue, we're going to obtain COGS, then operating expenses, right? So let us take the revenue. Revenue is basically 7,500 crores in 31st March 2014 year. But in the next year, of course, there's going to be a growth rate of 20%. Okay, so 20% is the growth rate in the revenue as well as EBIT. Okay, so let us say the revenue is year 0, it was 7,500. So on that 7,500, you can say it's going to grow at 20%. So this into 1.2. And then in the 4th year, is going to be year 3 into will grow at 15%. Sorry, after that it's going to grow at 8%. So that's going to be 1.08. Right, so 13,996, that's the revenue. EBIT is also supposed to be growing at EBIT will grow at 20% per annum. So now I need to look at like COGS is 3,000 out of 7,500. So if you try to calculate the percentage, that's like 3,000 out of 7,500. So 3,000 out of 7,500.
40%.
That's 40%, right? Yeah. So that 40% is going to be our COGS. So COGS will take 9,000 into 40%, right? So we got the COGS number. Now, after COGS, we look at the operating expenses. So, I mean, the operating expenses would be like 2,250, but out of this 2,250, I'm going to exclude the depreciation because capital expenditure net of depreciation is going at a different rate. So I need to remove the depreciation amount. So depreciation is 600 crores, which is included in your operating expense, right? So if it's included in your operating expense, I need to remove it. So that would be like 2,250 minus 600. This is the depreciation. This is the operating expense for the year 0. So on that, I need to take a growth rate of 20%. So 1980 will be the amount of operating expense. In the second year, it's going to be this into 1.2. This is 2,851. And then in the final year, in the 4th year, it's going to grow at 8%. Right? Okay. So that's your operating expense. Then we have like the depreciation. So depreciation obviously needs to be subtracted, and then we need to adjust the capital expenditure and depreciation data. So I just wanted to separate it. So depreciation is going to be like 720, and depreciation is also going to grow at 20%, right? Because they're saying EBIT is going to grow by that portion, but then capital expenditure net of depreciation will grow at 15% onwards. So capital expenditure less depreciation figure needs to be taken care at a later point of time. Okay. So depreciation.
Jagbanduji, this is CA Dr. Rajkumar Adukia.
Hi, good morning, sir.
Chairman, good morning, Chairman, Board of Studies, and you are doing wonderful.
Thank you, sir.
You are from which place, Jagbandu?
I'm from Mumbai, sir.
Okay, we'll catch up later. Carry on.
Yeah, sure. Okay, so depreciation, we have the 720 in the first year, and in the second year and onwards, it's going to grow at 20%. Okay, so then the next year it's going to be into 1.2, and then in the fourth year, it's going to be growing at 8%, right? So that's your depreciation amount, and then we say it is EBIT. So by subtracting from revenue all these items of COGS, operating expense, and depreciation, we arrive at the EBIT number. Okay, that EBIT is what we have computed, and it's obviously growing at that same 20%. Now we have separately computed depreciation for some other calculation. Okay, so EBIT is done. Now the tax. So tax at the rate of 30%. So we are going to simply subtract the tax from this. So on this, we take a tax of 30%, right? And then we have the profit after tax. So profit after tax is 2,700 minus 810, which is 1890. And same way we got the PAT, or not PAT, we can say earnings after tax, or after tax earnings. Okay, so we got the earnings after tax, but I need to adjust one thing in it, which is adding back the depreciation and adding back the depreciation and then reducing the capital expenditure. But one thing that they have specified is that capital expenditure net of depreciation figure, basically net of these two, is going to be growing at 15%, right? So instead of saying add back depre and then less capex, we can simply say in one single line, less capex, right? Or I can say less net capex. So net capex is basically going to be the depreciation, post depreciation capital expenditure. Okay, one second, just a moment. Okay, so net capital expenditure, the net capex is going to be, the net capex is going to be simply initial, which was 750 and 600. So the difference between these two is going to be 150. So that 150 is going to grow at the rate of 15%, right? So if it's going to grow at 15%, so 150 into 1.15, so that's 172.5, right? And then this into 1.15, right? So 198.38. This is 228.13. Okay, but in year 4, we are not going to write any of it for a simple reason. They're going to offset each other. So that's going to be a zero item, right? And then one thing we need to adjust is the working capital. Now, how do we go about working capital?
25% of revenue.
25% of revenue. So I need to look at the revenue.
Incremental revenue का 25% लेंगे.
Correct, yes. So we need to first take the revenue. Right. So we need to look at the revenue of 9,000. Sorry, we need to take it from year 0 onwards, right? So let's take it from year 0 onwards. Year 0 ka revenue was 7,500. Yeah. And year 2 onwards even, right? Okay. So working capital, we can say it's going to be 25, net working capital will be 25% of revenue. So I can say simply year 0 revenue multiplied by 20%. Okay. So incremental working capital will be the difference between the previous working capital and current working capital, which is 300.
So, it's 25%, not 20.
It's, what did I take? Okay. So it's 25%. Right. So we got the working capital numbers, incremental working capital. This is the additional capital infusion that we need to make. That's the initial investment that we need to make. So we are going to subtract the working capital investment basically. So that's like in first year it's 375, and then for the subsequent years we got it as 450, 540 and 259.20 respectively. After adjusting for this, we will definitely get the free cash flow for the firm. Right? So free cash flow for the firm is going to be like earnings after tax. From that, we are going to subtract the net capex. From that, we are going to subtract the working capital. Right? So 1342, 1619, 1953, and then 2680.13. That's your free cash flow for the firm. Now the next task is obviously to take the present value of it. And so let's take the present value, but before that, we need to get the terminal value. Terminal value will be free cash flow for the firm. Obviously, we want the free cash flow for the firm in year. The terminal value is like we value in the year 3. So free cash flow for the firm in the year 4 divided by
Cost minus
growth. Yeah. So this free cash flow is 2680.13, and then we divide it by 0.15 minus growth rate is 0.08. So this is 2680 divided by 0.07. This is the terminal value. Now we just need to write down the year, the cash flows, the PV factor, and the PV. So we have like year 1, 2, 3, 4th. No, not 4th year, right? We'll just take the 3rd year only because we were taking the value in the 3rd year itself. So first cash flow is 1342.50. Then this is 1619.63, 1953. And again, third, not this, but this is going to be the terminal value. Right? Okay, PV factor. What's the working weighted average cost of capital? That's given as 15%. Weighted average capital is 15%. So we say PV factor at the rate of 15%. So this will be 1 divided. I think the PV factors are given. Let's take those. Yeah, it is given. So PV factor is 0.8696. 0.8696. Then it is 0.7561. Then it is 0.6575. 6575. And this even continues for the 3rd year. So the PV is going to be cash flows multiplied by PV factor. Right? And then we take just the summation of all. So we get the value of the firm as 28,850 crores. Right? So 28,850 crores is the value of the firm. Okay. Is this clear, everyone?
Yes, sir.
Yeah, perfect. So we have done a quite good number of questions regarding the entity valuation using the cash flow approach and also the earnings capitalization approach. Now, before we close the session, I would like to end it with one simple concept called as economic value added. Economic value added, or which we simply call it as EVA. This is a concept which is used widely and also practically relevant when you want to understand how the company has really performed. Right? What value addition company has done through its operations, right? So economic value added is simply to understand what is the required, or I can say what is the expected or required return by investors of company. Obviously, we are looking at required return in INR. So in rupee terms, if I ask you, what is the required return of the company? What is the required return of the company in rupee terms? So in INR terms or in rupee terms, how much return would an investor or would all the investors would be needing from the company? It is very simple. It is invested capital. Can I say multiplied by weighted average cost of capital? Right? So all our investors, whatever money they have put, on that the company needs to earn a WACC, or a weighted average cost of capital. Right? So if let's say your invested capital is 1,000 crores, on that your required return is 12%. So you would be like, simply be expected to generate a return in INR terms, operating return or operating profit of 120 crores. Now, of course, this has to be a post-tax number, right? So this is the expected return or required return by the investor of the company. Now, when will you say that company has added value from its business? When will you say that the company has added value from its business? Can I say when your actual return is more than this expected or required return? As financiers, as investors of the business, you would like to have a profit of 120. As financiers or as investors, you would like to have a profit of 120. Now, of course, this 120 is what is expected or what is required. But we will say that if the company has really done something good or added something value, it would be generating a profit or an operating profit of more than what the investor would be required, right? So we would like to know what is the actual return in INR, right, generated by investor. What is the actual return in INR generated by investor? So we would say simply that it's EBIT into 1 minus tax rate. So that's EBIT into 1 minus tax rate. So EBIT into 1 minus tax rate. So let's say earnings before interest and tax is 200. And on that, you're having a tax rate of 30%. So what's the EBIT that we have generated? It's 140, right? So as an investor, as a holistic investor, we were expecting the company to generate a return of 120. But the actual return which is generated by the company, which is EBIT post-tax operating profit, that is 140. So what is the value addition done by the company?
20.
Economic value added is 20. So we simply got this 20 as, like 140 minus 120. And we know this 140 is nothing but EBIT into 1 minus tax rate, which is this figure, minus the invested capital into weighted average cost of capital, right? So it's simply comparison between the expected return and the actual return. So if your expected return is lesser than your actual return, it means the company is doing a great job. It's able to generate good amount of returns for its investors. Okay, that's a simple concept of economic value added. Now, more about it, the numericals on this and other discussions will be taking up in our subsequent sessions. Okay, So I hope this has been a really interactive session with me. We've understood the valuation concepts. It was just a repetition of security valuation, but then yes, we are looking at it from the overall business perspective. Okay, guys. So any queries you have?
No, sir.
Okay, okay, students. So Divas sir, thank you very much for your taking the interaction. Oh, sorry, Jagbandhu sir. Thanks a lot for taking this very interactive session, and your initial beginning with linking the firm valuation with the security valuation is a marvelous, because ultimately in a security, when we are considering a security on an individual wise, but here we are taking it overall firm wise, and free flows of the cash firm is very important perspective from the valuation angle. And since you have started with the EVA, it is one of the important topics. Sir, I request in the next class, please repeat it again, because some of
Yeah.
the have been left out because due to some reasons.
True.
So they will also get the benefit of the same. So just revise briefly in the next
Sure,
session.
sure.
Okay, sir. And so far as any query is concerned, students, you can send your query at sfm-final@ICAI.in, or you can contact me at this number. Or you can underwriting send your query at through mobile app as well. So student, in the next class, I think Jagbandhu said this topic will be over in the
Yes,
next.
yes, it will be done.
In the next session, this topic will be over. So far the assignment is concerned, Jagbandhu sir has taken up the questions of the study material. They are available in the study material. But don't worry, by today's evening, I will get uploaded the assignment of the same. So that it will be helpful for your next class as well, and for your today's revision as well. Okay, student, thanks for patient listening, and have a nice day, and see you in the next class. Thank you. Have a nice day.
Thank you, sir.
Thank you, beta. Thank you. 2 minutes.
Thank you, sir.
Thank you, beta. Thank you, beta. Thank you.
सर
Yes, yes, beta.
मेल आईडी में एसएफएम स्मॉल लेटर्स में है, वो कैपिटल में टाइप हुआ है।
नहीं, वो जगबंधु सर से हो गया, मैंने भी लिखा है ना स्क्रीन पे, कोई बात नहीं, आप स्मॉल में करिएगा। ठीक है बेटा।
यस सर।
ओके बेटा। ओके, क्वेरी नहीं है, आई थिंक वी कैन वाइंड अप द सेशन। ओके अशोक जी, नाउ वी कैन वाइंड अप द सेशन। थैंक